Thank you all for joining, who are coming in from wherever in the world you might be, joining the New York chapter of the University of Chicago Booth School of Business alumni event as part of our entrepreneurship series. This is the second in our series, and we're excited to move on to an exciting topic tonight, which is a 360-degree view of your venture. We will have our very own Dr. Aladad from Booth lead us through the discussion with our panelists. And before I hand it over to Tamir to do that, let me introduce Tamir. Tamir founded Mindful Care out of Chicago Booth, where he graduated 2017. And he placed first in the Polsky Center for Entrepreneurship and Innovation's Global New Venture Challenge. And we are excited for him to lead us through this. To date, he has raised close to $5 million and those locations in New York, New Jersey, Illinois, Michigan, Florida, and Connecticut. We look forward to leveraging his experience along with our panelists as we take our second dive into this entrepreneurship series. We invite everyone to stay close on upcoming events for the New York chapter of the University of Chicago Booth School of Business, and hope to continue the conversation with you soon. I'll hand it over to you, Tamir.
Great. Thank you very much, Whitney, for that introduction. Things move very quickly at Mindful, and really, since I should update the introduction, since then we've actually closed the Series B and raised now a total of $11.5 million. But we don't need to split hairs. So things are going well for us, and we are very blessed. And at the end of the day, it's really this network and this community that has given us the opportunity to do that. So we're certainly very grateful. And it's events like these where we learned a lot about what goes into building a venture and a successful venture. So we like to pay it forward and continue offering these type of events for aspiring entrepreneurs and those that are in the space of early stage and growth stage development of their company. So without further ado, let's get started. The event today is titled "A 360 View of Your Venture." And we came up with that to really understand if you're in fundraising or considering fundraising, different perspectives that the organizations you'll be interacting with and the firms you'll be interacting with, what's their perspective and what are they prioritizing? And is it different if you're an entrepreneur and are your priorities aligned with a venture capitalist or private equity firm or family office or an angel investor? So I thought it'd be great to speak to some leaders in the space and ask them some questions and understand how they evaluate deals and what they focus on. So an entrepreneur is more informed when they're out there fundraising. As I found that very helpful when I knew what people were looking for, how I presented myself and how I presented the company and its growth, its strategy, and wanted to include other people in that understanding. So with us this evening, we have Mark Groner of Sopris Capital, Dan Caruso of Caruso Ventures, and Ricky Roman of Cathay Capital. And I will allow them to introduce themselves a little bit. We can go in that order. So Mark, go ahead.
Yeah, I'm Mark Groner. I'm a partner at Sopris Capital. We're a 20-year-old family office and venture firm based in Miami and Denver. We're primarily getting involved with the Series A, Series B level. Most of our investments are in the healthcare technology sector, but we'll also do B2B SaaS and tech-enabled services.
Great, Dan.
Hi there, I'm Dan Caruso, Chicago Booth from early 90s. And I'm a recovering entrepreneur. I've been part of 3 scale-ups. The first one started in Chicago. I joined it right after I left Booth, and it was one of the earliest competitors to the Bell system in building out fiber networks. We then became the biggest internet backbone in the world through our acquisition of Unet in the early stages of the internet. We sold to WorldCom, and that led me to move from Chicago to Colorado, where I am now, and the launching of Zayo Group. So a few of us got back together. We started Level 3. Level 3 became and is to this day probably the biggest carrier of bandwidth through its now brand as Lumen, but the heart of Lumen is Level 3. I left there after about 7 or 8 years to take private of a distressed public company, also in the fiber space. And that was my first experience as CEO and my first experience being directly backed by private equity. And it was a very successful outcome. We invested less than 9 million and within 2 years took out closer to 250 million. That led to me founding Zale Group in 2007 here in Boulder. We went public in 2014 and we sold in 2020. So, and that was a very good outcome as well. We invested about $1 billion of equity, throughout the life of the company. And at exit, it was worth about $8.5 billion on the equity side, 14 billion overall. And I've pressed my luck, and I'm not going to press it again as an entrepreneur or operator, but I've built out a single family office and I'm doing a fair amount of direct investing in tech-enabled companies.
Well, hopefully you could channel some of that luck towards Mindful.
Yes, absolutely.
Awesome. And last but not least, Ricky Roman.
Yeah, I'm a vice president at Cathay Capital Private Equity. We're a global independent investment platform, started about 14 years ago. Today, we manage about 5 billion in assets, invest across venture, growth, and private equity, and specifically my focus on growth-oriented investments in control-oriented private equity investments, mainly in the healthcare, consumer, and software space. And prior to joining, also was part of a management team of a mental health, private equity-backed mental health business called Refresh Mental Health, and helped scale that considerably as an operator. So looking forward to the discussion.
Great. Thank you, gentlemen. So the way the discussion is going to work, we'll start with asking all three of you the same question, really trying to understand how you find and source deals, what you prioritize, what's important to you. And the questions will get a little bit more specific towards your firm. So feel free to chime in when it really applies to you, and then we can take it from there. And then, all right, so let's get started. So share with us a little bit. We could do the way you're on my screen. We could do that order moving forward if you're comfortable with that. So we'll start with Mark. How is it that you find and source your deals?
Yeah, I think it's probably helpful to know how I don't find them as well. I don't find them via cold emails. So I get tons of cold emails from people, and that's an automatic delete because I just don't have time to go through all the cold emails. And if they're cold emailing me, I know they're cold emailing 50, 100, 200 other people. So those are, I found over my career that those are a waste of time. The way that, each deal that I've done, it's probably come in a different way, but it's usually from my network in some respect. It's either a board member I've worked with in the past, maybe a past CEO, maybe a friend, a family friend, maybe another venture person, a later stage private equity person, but it's usually some sort of warm referral from a trusted source that I know. And that just sets the conversation off just a much different level than if someone just, I met someone at a conference or, met someone at some random event. So it's usually from my network.
Is that Dan? Does that resonate with how you find your deals?
Yeah, to some degree. If you look at Crucial Ventures website and investments, you'll see what looks like very little pattern recognition, both from a geography, a sector, even a stage standpoint. For a small group, it looks all over the map, but there is some rhyme to reason. And the first, it really has maybe 2.5 prongs. The first one is Colorado, and in Colorado, we make it our business to know everything that's interesting happening out here. So we don't necessarily wait for people to approach us. We'll approach them, but because of my, reputation in the Colorado community, typically if I want to get in on a deal, they'll find a way to get me in on a deal. Just have to learn about it at the appropriate time. And, the most interesting deals often are ones that, that don't just fall into your lap, ones that, you have to do a little bit of work to match yourself up with it. But a lot of those come, just as Mark said, through contacts. We just did a deal last week called All City Networks, and there's a venture firm in town who said, hey, this is one you're going to want to take a look at. So went through a really strong filter. So that's category one. Category two is an organization called Endeavor Global, which is worth probably anyone on this call taking a look and learning more about. Endeavor Global is an investor. Even though they're a nonprofit, they're an investor through a VC fund that they manage in more unicorns throughout the world than anyone else if you remove US and China, and if you count for earlier stage. So more than Tiger, more than Andreessen, more than SoftBank. So I'm deeply affiliated with Endeavor. I led the founding of Endeavor Colorado, but we use Endeavor as a way of curating deals. So when a company is working their way deep into their process, that means it's been thoroughly scrutinized on a global scale. And if you get access to those deals, it's a very curated platform. And then the third one, near and dear to this call, is we do spend a lot of time with the University of Chicago through Polsky Center and otherwise, and we do invest in the New Venture Challenge winners selectively. We do that to support the university and to support Polsky Center, but sometimes those companies will do a follow-on with, and then we treat it as a more intentional investment. And Tamara in this case is an example of that with Mindful Care.
Nice. Yeah, and we do appreciate your ongoing commitment to mindful round after round, which is pretty remarkable. That we haven't, the syndicate hasn't changed with each round. So certainly grateful for that vote of confidence. I think Mark and Danny, you both hit on tapping into your networks as the underlying theme, and you also look at very similar deal sizes. I'm curious, Ricky, if beyond just tapping into your own network, like Dan and Mark were saying, that there are other ways, especially since your firm deals with a little bit later stage companies, that you source your deals.
Yeah, definitely. I think it's at the later stage, there's certainly tapping your network, but we think about it, our sourcing funnel from really a thesis-driven approach where we want to find sectors and do a bunch of work up front on sectors that we really like. If they're high growth, align well with the industry, there's clear catalysts for businesses there. There's maybe no market leader today. So there's a number of kind of filters that we apply to different sectors, and then so we try to get deep there first, and then once we've identified several key sectors in each vertical, we proactively kind of find out who are the companies that are leading those sectors, and we've also used our network of banks and brokers that actively shop deals in those sectors and really use a two-pronged approach in terms of building relationships with founders that operate those companies that we've already really identified, and also looking at incoming opportunities that are being brought to us by a bank or a broker. And there's many different sizes and forms of brokers and types of deals that they source and will bring out to the market. So I think our approach is maybe a little bit different than Dan and Mark, and I think some of it's maybe based on the stage of in where we invest in what stage company.
You hit on broker, which is I got to tell you, I've heard very mixed things about using brokers, and it's certainly we get cold emails all the time from brokers, especially once they hear we're fundraising. Curious if that's a route you would recommend for an early stage entrepreneur. Is it appropriate, or is it better for them to tap into their network or their alma mater, or everyone hears from Booth and you tapping into alumni? That's all three of you. What are your thoughts on brokers in general? Mark, we could start again.
Yeah, if it depends on how big of a round you're raising. If you're raising like a seed or a Series A round, less than $5 million, then you should not hire a broker. You should be an entrepreneur. You should hustle. You should make contacts and reach out to people through find a way to get a warm intro to some of these firms. If you're raising like if you're already on your way and you're raising a $50 million Series B or $100 million Series C, then we've seen some, banks and brokers help out. But at the earlier stage, it's more of a turn off, I would say, if a company has a broker.
Yeah, and the turnoff it's correct if you're too early and you have a broker. And I went through this experience. We used a broker when we were doing cold quanta because we didn't have a CEO. I was interim CEO and we wanted to get some fundraising momentum in parallel with doing a CEO search. And a lot of investors view that as a sign of weakness. If they get approached or they have participating a broker, it just doesn't feel right for a company that's Series A or below. But there's a big role for brokers as companies get bigger, and you need to kind of cast a wider net.
Yeah, I'll maybe speak about it from kind of the later stage. Once a lot of companies that we're looking at are break even to profitable, and I think the equity check sizes that we're typically looking at is 20 to 100 million per deal, and we expect that the company is going to want to go out there and get the best terms that they can, and in those cases, whether it's growth capital or majority control deal. A lot of the market standard is to use a bank to really help you navigate that process, because it's an important decision for an entrepreneur, and there's a lot of considerations that go into it, and many times, especially on the control investment side or a buyout, an entrepreneur won't have necessarily been through that before. So relying on the expertise of a bank, has been a reason that people have taken that approach.
Yeah, no, I agree. There's a point where it could be premature and it could backfire. And I think that was the advice that was given to me, and also the sense that I got when I was basically on a roadshow meeting with prospective investors, and there was a point where it felt really premature, and that totally makes sense. I am seeing in the chat that people wanted to perhaps transition this more to a roundtable discussion. Happy that those of you that are in attendance, if you have specific questions and you want us to kind of weave that into the conversation, that's no problem at all. At the end of the day, the purpose of this is for it to be meaningful if you're here. So I will open the Q&A section so we could see some of those questions, and then we'll weave them into the discussion. So instead of having a designated Q&A time, which was supposed to be in about 25 minutes, we'll weave that into it now, so you can really feel like your discussion and direct the where the discussion is headed. So that's appreciate the suggestion. Happy to incorporate that into the format. So we talked a little bit about how you source deals. We kind of got off track a little bit with brokers. But one of the things that I hear a lot from entrepreneurs is what's the most important aspect that the firm I'm speaking to will be looking at? Are they looking at my growth strategy? Are they looking at my run rate? Are they looking at my total revenue, my burn rate? Where should I be making sure that I'm giving them confidence that we're going to succeed? Is it just the team? Is it the CEO and the face person that matters? Is it, one could say a little bit of everything, but curious to hear from your perspective, if you had to pick one or two things that really are important when assessing a deal, what would those be? Another one, it could be the vision. And if you come from a very thesis-driven firm, the mission really has to align with your priorities, and if it's social impact or whatever, right? So there's many answers, but if you had to pick one or two, I'd be curious to hear what exactly is the most important aspect from your perspective when assessing a deal.
Yes, well, I'll give the most obvious answer, but it's also should be the answer in nearly all cases. So that is leadership. And leadership starts with the leader, or in some cases, it could be two people, but it really is, who am I entrusting with the investment? And do I think they will, they are of the nature that they're going to be successful? Okay, so whether you're growth stage or your venture, or anything else, the emphasis on the leader gets a lot of lip service. Every investor will give that as an answer. Maybe 1 in 5 investors really understand the full importance of that answer. That's not the only thing, but it's certainly the common denominator, and it's, I think, probably the most important thing. Now, at the next layer down, it becomes important too, because a really good leader, the first thing you'll see is they have really good people around them for the roles that they're in. So the strength of the team is a sign of a strong leader on top. So that maybe is the next level down. After that, it's very situational dependent. It's like, is this a venture investment? Is it a buyout? Is it this? Is it that? There's other factors depending on the type of investment, but for all types, the leader, and then is that reflected in the broader team?
Great point, Dan. I would agree on the leadership aspect. For me, since I'm at the Series A level, it's all about traction for me. So you can talk about, like, did I hire a good leader and then a good team, and is my thesis good, and is the market good? All those ingredients lead to customers one day, and so the customers and the revenue traction is the output. And so many Series A investors are really going to be focused on that. How many customers do you have? Are these good customers? Are they large companies that are well respected? Do you have many customers? How long did it take to get these customers? So I really spend a lot of time on revenue traction and who the customers are.
Yeah, I think at the later stages, there's a lot of overlap, and at some point when the business scales, ultimately, we'll start to look at cash flow and the ability to generate positive cash flow, positive EBITDA, and what the economics are around that for a business at scale. And I think that's maybe the one additional layer, or one of the differences that we'll think about in the later stage. It's time to profitability, or if you're at profitability, what do your margins look like, and how sustainable are those, and really getting understanding of what that's going to look like in the future as well. And so I think that's in addition to what Mark and Dan said, another lens that we'll look at, and really just understanding the financial profile of the business, and ultimately, how that's going to evolve.
Mm-hmm. No, yeah, that makes sense, right? As the amount of quantitative data that you can provide super early relative to later, right, gets more and more sophisticated with time. So there are more data points for you to tap into. But really, at the core, I do think, even just from my experience, the leadership team could make everything, right? It all trickles down from the early stage decisions that you're making. Right, that leadership team is crafting those unit economics. So if the unit economics aren't sound, Ricky, you won't get the financials you're looking for. So it's I guess if I had to pick the core building block from my experience, really it's the overall strategy coming from the CEO, and then the actual muscle that's executing. Even there could be disconnect, right? I can have great ideas, but then if my team's failing me, what good are my great ideas, right? So totally agree with all of you. So that brings me to really the balance between an idea and its execution. And really we going through GNVC, NVC, the Polsky Center, we see a lot of great ideas. People identify problems, people propose solutions. But ideas are a dime a dozen. It's all about execution. And I'm curious how true you think that really is. Can you take a good idea, swap out the leadership team, and run with it if you see the idea itself has potential? Or does that not really matter? Really, you know, a mediocre idea with excellent execution is much better than a brilliant idea and mediocre execution. Where are you putting more of your emphasis?
Yeah, so, well, I'll let one of you guys go first this time.
Yeah, I can go first. They're obviously both important. I think on the execution side, if you've got an A+ management team executing on a crappy idea, it's not going to work. So we spend a lot of time digging into idea / market, whatever you want to call it. We got to have high conviction on that, and then on the execution front, you're kind of making a bet on the entrepreneur. Like when we invested in Tamir, you seemed like a smart guy, went to University of Chicago, has an MD, but you just don't know, how well he's gonna execute on things. He's done a very good job executing, but you just don't know. So I'm focused much more, at least initially, on the idea, the market, making sure that that's sound, and then I'm kind of taking a leap of faith a little bit on the entrepreneur to execute.
Yeah, I'd probably put a slightly different spin on it. So what is a excellent management team and a poor idea? It's something that's not going to last very long, because an excellent management team is not going to be with a poor idea. If it was their idea, they're going to figure out really quick and would have pivoted before you can even figure out it was a poor idea. If somehow they got stumbled into a poor idea, they're going to bail out almost immediately. I mean, their next management team, what they do, wasting their time on a poor idea. So it's almost like if you're in that situation, you're missing either the assessment of the management team, they're not a great management team, or the assessment of idea might look like a poor idea to you, but it probably isn't. So that doesn't last very long. I do agree that, if somehow you could take an excellent management team and put shackles around them and say, you have to do this no matter what, and it's a poor idea, they're not going to be successful because it's a poor idea, and you can't, make a bad idea successful just because you're a great team. You have to find, something that's better than a good idea. So the idea's got to be good. So the business has to be predicated on a strong foundation of what you're trying to do business wise. But it's far more important to have an excellent management team and a good idea than the best idea in the world and allows a management team, because that's just going to be a waste. They're not going to somehow figure out how to execute a good idea if they're a bad team. It just doesn't happen. They'll show how even a good idea can be screwed up by a bad team. That's what they're going to show you.
How about later? Where does that land?
I mean, in the growth in PE world, I think we're more risk averse, and a lot of times the way we think about it is, say it's an idea for like an additional avenue for growth. We like to have a couple of different ways that we can work with the management team or the founder to generate additional growth in the business. Whether that's a new service line, new product. Maybe there's an ability to acquire a competitor, because we're assuming that one or two of those likely won't work out. But if we have like 4 solid opportunities or ideas on generating growth, then even if we kind of try our darndest on 2 and they don't work out, we still have 2 that could work and could add a lot of value to the business and ultimately to the customers that this business serves and to the market. So we try to really hedge risk. I think on the private equity side, and when we think about ideas and execution, it's kind of where's the highest value, lowest execution risk opportunities for us, and so we kind of think about it from a matrix almost in that standpoint.
Yeah, there's like a hedging component for sure. That makes sense. So I guess we talked a lot about assessing deals, and then you have this idea and you've been running with it. One thing that I grappled with throughout all our fundraising rounds, from the friends and family round to the C to the Series A and the Series B, what's the magic number of how much I should raise? And that's something that I grappled with a lot. And when I went out to fundraise, firms would tell me how much I should raise. Some of those times I wasn't sure what I would do with all that money, which was definitely a blessing. But check sizes sometimes seem really big. Other times they seem really small. I was like, I can't do anything with that, right? So I do believe that it's an art and not just a science. But curious from your perspective, if you were giving an entrepreneur advice, how much should they really go out and ask for so they're not under raising or over raising? How do they really find that sweet spot?
If it was a year ago, raise a lot more than you need. If it's right now, raise as little as you can possibly get away with to, ensure you're protecting your business. Maybe buy yourself some runway, but now's not the time to, take more than you need or even as much as you'd like to have, because so it's there's some layer of what's going on in the marketplace for investing that drives the answer to that question. There's a lot of other things too, but, the contrast in today's environment versus a year ago, is a opportune environment to just live in the reality of the question that it is easier to raise money. And sometimes you get more money at higher valuations and what might look like a lot of dilution in that environment. Now you fast forward to today, you're like, shit, I should have taken more money at that higher valuation. It was greed that took over and I lost perspective.
No, I could definitely see that. And I think even when people used to tell me just, raise as much as you need, I wouldn't know what to do with that, right? Because how much I need to what, how aggressive do I want to really be here? And in how much time do I want to do it, right? For me, when I have multi-site healthcare facilities, I can go gangbuster with crazy check sizes in 18 months. I can grow a little more conservatively and take a conservative check size and last 24 months, 36 months, right? So even then it's hard for the entrepreneur to calibrate himself to what's going on in the market, because we're I think as entrepreneurs very committed to growth and expansion and being aggressive, and kind of there's that adrenaline rush there that's driving you. And then when you look at whether it's easy or difficult to raise, it's sometimes challenging to decide really what that right number is. So Mark, how about you and Ricky?
I would say, first of all, like raising money from venture or private equity is not for everybody. People think it is for everybody, but it really isn't. When you're taking money from an investor, there's strings attached. They want to sit on the board. You're not only giving up, dilution, but there's other, protections and limitations or rules that you need to follow by. The rule of thumb usually is you raise 18 to 24 months of capital. When you look at why businesses fail, one of the main reasons why they fail is because they run out of funding. So if you're increasing your burn rate and you're going to run out of money within 12 months, it's a very risky scenario. So I always say probably 18 to 24 months. And then also think about it in a lens of, this is a very expensive capital. It's dilutive. I would raise kind of what you need for that 18 to 24 months, and maybe do a little bit of a cushion. But that's a total swag, and it's market dependent. Like Dan said, maybe you'd raise a lot more last year and not raise it all this year.
That makes sense. Ricky?
Yeah. We always like when the entrepreneur or founder that we're talking to has an ask and then has like a very clear plan that backs up the ask on how the capital is going to be used, down to the dollar. And I think in our minds, it kind of shows that, this is a well thought out plan. They've done the work behind it. They're very confident in it. And I think that gives us confidence in the number that's being asked, whether it's, raise less or raise more. I think we play less in that world. But one thing that we're focused on is, if company isn't profitable or is close to profitability today, it's really asking the question, how do we get to break even to profitable with the capital that that you're going out to market with. So I think we think about it more in a timeline of how does the business become sustainable without needing equity in the future. And so that's a question that we ask and that we scrutinize and try to think through with the founder or management team of business that we're looking at investing in. And I think it's a critical one for us.
No, for sure. But I think if you take all three of your answers, right, and you take that 18 to 24 months of runway, and you plug that into your pro forma of that there's this clear path to profitability, however long that may be. How much do we need to survive for another 18 to 24 months on that clear path to profitability, and then that closer to a number that makes sense, right? So that's certainly a place to start, right, and start having conversations. I think that's helpful. We do have a question from one of our audience members. He's asking, have any of the panelists had significant conflicts with other funding sources on deal characteristics? How are those resolved, and what was the effect on the trajectory of the venture? So I'll open that to anyone who wants to chime in.
Definitely have conflicts when you've got co-investors. People have different goals and aspirations, and I've been involved in companies before where they want to go raise a mega round, $20-50 million round, where I didn't think it makes sense to amp up the burn and the risk, and they did. And in those situations, we generally leave it to the entrepreneur. Whatever the entrepreneur believes is right, usually we'll back them, and that's how we resolve that in that situation.
As an investor, I really haven't yet had what I would consider a material issue of that sort, and I'm certain I will have that at some point in the future. I think that's really good advice, Mark, that if there is conflict, make sure that the entrepreneur's voice becomes very important in that, and that you're willing to, within reason, willing to get behind, the entrepreneur if the entrepreneur has a strong point of view. But the best thing is to find ways to avoid being in that situation, if at all possible, because when things start to get conflicting at the cap table level or at the board level, the probability of a successful execution, goes down, because you've just put the leader in a position where they're trying to herd cats, and they're trying to resolve differences, and they're needing to consume time and energy in areas that can be a drag on the business itself. So, to the extent that could be avoided, you avoid it.
I think we run into conflicts. I think less so as well. Typically, we're the main institutional partner or the majority partner in the business, and I think where there can be conflicts later on is around the use of debt. And if that can be a great funding source to help grow a company, but I think there's inherent trade-offs when you use debt versus equity in terms of the amount of flexibility you have. And where debt, you have to be very conscious of cash flow, servicing it, meeting covenants, and there's kind of inherent ways that you need to maybe tailor your business when you decide to take on debt at some point, and if you decide to take on debt, versus just having all equity in your capital structure. And a lot of times it can lead to more conservatism in the business and how you grow, because there's that kind of additional requirement of the cash that your business is generating. So I think that's where one of the kind of considerations that we think about from the capital structure as the companies mature.
That makes sense. So let's talk a little bit about, I realize as we're discussing different types of firms, not everyone in the audience, might know the difference. I mean, we might have started with that assumption. And if you are really early stage and haven't even had a chance to understand the difference between raising from a family office versus a venture capital firm versus private equity, and what that looks like, love for you to give some insight as to, when considering different types of firms, what you should think about. Because a lot of times you hear these terms and people speak to firms that have a venture wing, but they're really private equity, or we're family office, but I'm an angel investor. So there is, there are, it's not as kind of binary or black and white, depending on different firms and then their portfolios. But at a high level, curious to hear what advice you would give an early stage entrepreneur considering different types of firms and what the differences are, particularly.
If I'm an entrepreneur, I would, as you're talking to investors, learn a little bit about what their goals are for if they invested in you, what are they looking to see? So you've got some, well-known venture firms that are playing for the Grand Slams, the Andreessens, the Sequoias, just billion-dollar bust type ideas, and that's worked well for them over the years, but it doesn't work well for all entrepreneurs because it's a very risky strategy. So venture firms come in shapes and sizes. I work for a family office but I pretty much act like a venture firm because our investor, or the family patriarch, came from the investing world. So a family office typically, they're not out raising funds. So, they theoretically have additional capital to invest in. There's no set fund life. Usually they're a little more patient on the timing, and it's more of, can you generate returns rather than, can I collect fees, just to be a little simplistic about it. But I would say, even like in the different classes, you just got to know the specific firm, really well, because the variability is so wide.
Yeah, so really studying kind of their ethos and their priorities to assess how they view you as an entrepreneur and their expectations.
I'll maybe add on to Mark's thinking comments there. So we're, Cathay Capital, we're an institutional private equity and venture capital firm. And, like Mark said, we have, finite fund lives, and that's certainly a consideration. And, I think one of the benefits as a larger institution that we bring to the table is, a lot of ecosystem members. We have a lot of corporate limited partners that we try to, connect our businesses with. We have operating partners that, have gone through a lot of the kind of growth challenges that businesses are seeing. And I think we're able to leverage some of our scale to, bring additional resources in to help companies. And would also say that it's, get to know the firm and also get to know the partner or the deal team that's going to be working with you, because that, that can vary group to group or even individual to individual. And, I think each partner and each team kind of has their own style and way that they approach working with the company and an entrepreneur. And, I think that's a very personal decision, but, spending a lot of time getting to know kind of the person that you'll be working with and the investor that you'll be working with is something that, we encourage the companies that we invest in to do, and we like it because it's a two-way conversation. We want them to be comfortable with us, and we want to be comfortable with them, and make sure that we're very aligned. So that's maybe something to think about, as you go out to the market.
Yeah, I mean, one piece of advice that I think is appropriate here is, and it's easy advice to give, it's hard advice to really follow through on, and that is building relationships with prospective investors. If you could get a huge jump start on that and build a relationship over time, way before you need them to or want them to invest in your firm. When it gets to the point where you're looking for investment, you've already narrowed it down, hopefully, to individuals and firms that you feel like you could work well with, that could add value to your business. And then you can move more quickly when you want to invest money. They've already gotten to know you and want to get behind you. And so start early, find ways to find that, 2 hours a week, 3 hours a week to be building relationships with prospective investors way before you want to go on a roadshow.
Yeah, I think the relationship thing was actually what served me the best. That rapport that was established created a level of trust and transparency, which, I mean, Ricky also talked a little bit about transparency as well. And then you can really assess alignment, right? And that goes back to what Mark was saying with recognizing their expectations and seeing if you could deliver on those expectations. And then that's when the name of the firm, I think, is less important, at least for me. You can call yourself private equity, you can call yourself, I don't really care what you call yourself. I think I need to know where we're headed and what do you expect of me and how soon do you think I'll get there? And are we culturally aligned, right? Is there that relationship, that rapport? And if there is, and I feel like I can meet your expectations, like then we should continue the conversation. So really, I think between everything the three of you said, those are all really valuable insights. I've noticed that kind of going through fundraising, and talking to a lot of entrepreneurs, everyone believes their business is the best. Everyone is building a unicorn. Everyone is incredibly excited. They've solved the most important problem in the world, and the solution is right here, right now. The time to invest is today. So I'm curious from your perspective, because I'm sure you hear that a lot, and a lot more than me. I mean, I only mentor a few people. What are some common red flags or pitfalls that the overly confident, overly zealous entrepreneur tends to be blind to or not realize?
Well, one of them came to mind as you were kind of coming up with the example for the question is, certain people are promoter types. They're always promoting what they're doing, how they're doing it. So they want to almost exaggerate, and they think it's their job to exaggerate, like they're trying to sell you on something. Red flags go for me when I start feeling like, is this a promoter, or is this an enthusiastic entrepreneur? When do they cross from one side of that line to another? And there's a company I'm investing in who, has a younger CEO that has a lot of promise. He's clever, so he's got a lot of really strong entrepreneurial traits. But he also gets, real close to, maybe crosses over that line of being a promoter. And at the end of the day, I didn't participate in the last round at the very end because I was worried about governance. That is, this guy, does he understand what his responsibilities are to his investors when he takes their money? You're responsible to be transparent and to be as matter of fact as possible with facts-based material, and differentiate that from when you're talking enthusiastically about what you think the bigger prospects for your business are. When those two start to become blurry, it's like, are you really telling me what's going on? Or are you? Yeah,
there's that used car salesman phenomenon.
Yeah,
where you lose the authenticity is lost because you're laying on very thick with the sales pitch, and you kind of don't know if the person's being genuine and authentic anymore because they're selling you hard, right? And that actually can be very uncomfortable to watch that.
And it's hard to reverse that once that starts to happen. You can't take that back. And so, and there's a lot of people very successful who are promoters. So it's not to say that anyone who has that tendency is therefore, because if you're not sure, you do have to think big, and or you're never going to create something that's big. But there's just putting your way through that and really executing your way through that.
Yeah, I think from my perspective, there is this huge sales component to fundraising. It would be naive to think you don't have to sell. But one thing that really improves the authenticity of the pitch for me is being very real about shortcomings and challenges, and not painting a picture perfect company where there are no problems and we're just we're flawless. But I think the vulnerability that comes with off the bat sharing your challenges creates creates a space where your audience can identify with you, and that's huge, right? So if you went and you were vulnerable and you shared something that's challenging with the way the company is growing or developing, or your own personal decisions that you're struggling, suddenly there's the level of trust there that, you know, I'm not just selling you a used car, I'm also telling you things that are wrong with it, and you know, it certainly improves the conversation versus being the used car salesman. So
it's a tricky balance, though, right?
It is.
You don't want, as an investor, you know, to come away from discussions where you feel like, wow, they're not really confident what they're doing, or wow, it sounds like glad you're being honest with me, but it sounds like you got a whole bunch of problems. So
Yeah.
you want candor, but you also, you know, you expect an entrepreneur to be, you know, we know as investors, and I certainly know as a recovering entrepreneur, you know, things don't always go as expected, and you have to fight your way through things, and there's always problems. You could always spend your entire day talking about the challenges you're facing and woe is me kind of stuff. So you want to know they're going to talk to you, you know, your CEOs that you back and teams you back. You want to know they're going to share with you the real challenges they're facing, hopefully with, you know, their ideas about how they're going to address them. You also want them to be able to come to you if they really need your help, and, you know, be in a position where they trust you enough to ask for your perspective or assistance. But you certainly, you know, want them to be strong leaders and be on top of the execution of their plan, which means overcoming their obstacles. It's a tricky balance.
Yeah,
it's hard to be an
for sure.
entrepreneur and do everything right.
For sure. And I would say it's actually it's very audience specific, right? You have to be able to read the person you're speaking to and know if they're looking for more charisma and enthusiasm, and they want the hype to get them kind of excited about we're going to take over the world, or this person's like, no bullshit, tell me what makes sense, what doesn't make sense, what keeps you up at night. I'm not looking for you to sell me here on this. I already know this is a problem and I know you're solving it. So have to be very dialed in, because the last thing you want to do is, if you're talking to a no bullshit kind of person and you're giving them this whole dog and pony show, they'll be like, get out of here. I'm not looking for this. So you got to also be very kind of have that EQ to assess who you're talking to. Mark and Ricky, how does this resonate with you?
I would say the red flags for me is like, just entrepreneurs being just overly optimistic. If they're showing, you know, it's got to be a balance. You know, you are a high growth company, but if you're showing that you're going to be growing to 100, 200 million, $1 billion in revenue in a handful of years, it's just, I don't think it's ever happened in the history of companies. So sometimes when that, you know, if the entrepreneur truly believes that that's true, then what else are they believing that's incorrect as well? So that's, for me, that's one of the easy red flags.
Yeah. Yeah, I think one that we see a lot in some of the later stage investment opportunities, or the later stage companies that we interact with, is like what we're hearing, what we're being told, and then what the actions reflect in the investment round. And, you know, one of the examples there is like, you know, we have this great forecast, you know, we're gonna double, you know, triple, quadruple in the next 3 to 5 years, but I want to take like a bunch of money out of the business. So it's all about like alignment, and, you know, ask the questions like, well, you know, if you believe that, you know, why are we, you know, why would you ever want to potentially take some chips off the table, or not kind of, you know, continue to build this company? So I think it's, for us, it's a lot about alignment, and, you know, aligning, you know, the ask, along with, you know, what we're hearing is kind of the future of the company, making sure that there's good alignment there, and that it all kind of makes sense.
I agree. Actually, we're at time for Q&A. I'll ask one last question, and then we'll open it to our audience. But the world of fundraising has changed significantly from when I first started in 2018 when we did our first raise, and we've navigated a crazy world over the last 4 years for many reasons, not just changes in the economy and how easy it was to get cash, to COVID, to just a lot of changes. If you had to forecast what fundraising and startup growth and development and expansion looks like in the next 18 to 24 months, what do you predict that will look like?
Well, I have a bit of a contrarian point of view. I have found myself going from being, over the last year or 2 years or even 3 years, a pessimist about what was going on in the environment. And for the first 2 years of that, I was wrong. Things kept going up. And then more recently feel like that, the fear of what was going on was well placed. I think from a stock market, public stock market standpoint, my gut is that the worst is largely behind us, that the stock market's already adjusted in anticipation it's going to be, that is a tough cycle and it will continue to be a tough cycle. So my gut is that the stock market's, not going to go down a lot further, as we go into next year and beyond. But but what the stock market tells you is that the economic cycle is going to take a while to play out. And my guess is you get, Mark and Ricky would have better feel than I do. But I think what's going to happen with private funds is, there's going to be some success stories and there's going to be some problems, and they're going to be slow to mark up the overall funds, because if they have something that is successful and causes a markup, they're probably going to use it as an opportunity to mark something out down to reflect where they have concerns in their portfolio. So hopefully you don't see a lot of markdowns at the fund level, but I think you're not going to see markups. You're going to see things just stay flat for a while, and hopefully, if there are markdowns at a fund level, that's probably going to be a year from now, because they would have run the opportunities to offset or delay taking adjustments downward. They're going to have to take them, but I don't think it's going to come to that. I think there's going to be a balancing out. But I do think it's, any entrepreneur who is wearing rosy glasses right now, they should put them away in a locked drawer, because it is going to be a tough cycle for at least a year when it comes to fundraising, when it comes to raising new money, when it comes to exits. So you're going to need to weather this storm. But I don't think you have to weather for 2, 3, 5 years. I think you have to weather for the first half of next year and into the second half. But I think things start to open up in the second half.
Yeah. I think the good thing for entrepreneurs right now is a record amount of capital has been raised to be invested really across the board in the last 2 years. And there's tons of dry powder out there. And I think that's in venture, it's in growth, private equity. I mean, it's just been a gangbusters couple of years, and there's pressure typically to put that money to work. And so there will be, I think, an appetite from investors, but it's likely going to be at a lower valuation than you would have, wanted to be at, or you were at maybe a year prior. And part of that, rates have increased. People are more cautious. So I think the terms are going to change, and it's also going to be very sector dependent. Healthcare and, high need, high stickiness with customers, with patients, and, businesses that can display that and continue to grow are going to be, there's going to be a separation, I think, of kind of high quality and of lesser quality companies. And that's going to be reflected in terms, valuations, and ability to raise capital. And I think it's sector by sector, and in business by business. And I think, those businesses that are doing well and have great management teams and great unit economics and in a very good market, a lot of room for growth, will still be able to get out there and raise funding.
I agree with a lot of what you said there, Ricky. I've seen funding kind of slow down this back half of the year, and I think it's going to be more the same in 2023. But there is still a bunch of money out there. You'll just be getting money at probably terms you don't like as much as you did in 2021 or early 22. But that shouldn't discourage anyone from starting a company. I mean, if you look back at some companies that were started during like the 2008, 2009, little recession, Airbnb, and there's a few others, but so that shouldn't stop anyone, but the valuation might be a little bit lower.
Yeah, that makes sense, and I appreciate that insight and ending on the note of kind of forecasting where we're headed. Gentlemen, I do appreciate all your answers and really giving a holistic picture of what it looks like to fundraise. We have added our audience to the remaining 10 minutes of Q&A that we have left in today's session. Feel free to turn your cameras on and ask our panelists or me whatever you'd like, and we'll just open it to a discussion for the last 10 minutes here and see what thoughts you have. Well, not all at once. We have a bashful bunch. I see, Dor, you unmuted yourself. Does that mean you're about to ask a question? Or not? Curious to hear though from the audience. Is anyone here an entrepreneur, or anyone here in an early, starting an early stage startup, or considering it, or fundraising right now? Would love to hear a bit about who's here and where you're at and what you're working on. If anyone's interested in sharing a little bit about themselves, we would certainly welcome that.
Is anyone there?
You think we have bots attending our web? This could be like a Twitter issue. Dor, go ahead. Maybe they're unable to mute themselves. That could be a thing too. I don't know if audience members are able to.
They should be.
I can't unmute you either. So if you are trying to speak, feel to talk in the chat. Dor, you are unmuted. So feel free to just chime. We're a small group.
He says he can't. He says he can't speak.
Oh, he can't. Oh, so that explains why everyone's so quiet.
Everyone's been given permission.
Yeah, I can't unmute anyone myself or else.
Or how about now?
Maybe now you can hear me?
Yes.
Yes.
All right. My name is Dorben David. I'm currently Executive Vice President at Medred Urgent Care. We have over 1,000 employees. I'm number 2 in chain of command after the CEO. My actual background prior to that is real estate. I worked for one of the most luxurious real estate investment team in New York City. But my network is real estate. And when I want to open my new business in the healthcare, I don't have the right network. Mark, you mentioned earlier that you are not really responsive for cold emails. Beside Roach, which makes sense, but definitely makes sense. But beside of Roadshow, if I don't have the right network in the healthcare industry or in the VC industry, what's the best solution to find the right VC or angel?
I would look on LinkedIn, see who your friends are connected with, to see if they're connected with any VCs, first of all. Other ways and if they're not, other ways, there's a few conferences in the healthcare space specifically where you'll get exposure to like the healthcare tech VCs. One of them is called the HLTH conference. Another one is called the Vive conference. And usually I'm not like a big conference guy, but those ones in particular are just really well done. And it allows you to collaborate and meet folks pretty easily that are like-minded. So that'd be a quick way for you to kind of jumpstart your network and the health tech side. I'm sure there's other ways too, but as I'm thinking, if totally organic, I mean, that's what I would recommend. I don't know if Dan or Ricky.
Gotcha. Thank you.
Yeah, the one thing I'd add to that is, unfortunately, there aren't any shortcuts for this. The entrepreneurs or CEOs that are effective at fundraising are investing in fundraising over long periods of time. So if it is through conferences, it's conferences they've been attending a long period of time, building relationships. They're finding people they know in their network, and they're using that to find other people that might be helpful. And all those take a lot of time, both in terms of how much time you spend, but also elapsed time. If you start that a month before you need to raise money, you're about 10 years too late. So you got to be doing that if you really expect to be effective at raising money, or you could get lucky by not doing that.
Mhm. Thank you.
The only other idea I might add to it, Dor, is to like try to find the firms that invest in the space where you're looking to build your business. That helps you get through that kind of first filter. If they know the space well and are already connected and kind of really understand what you're looking to do, that might remove part of a barrier. But Mark and Dan are much more qualified than I am to speak to that question. Just an idea.
Thank you. Besides that, I just want to mention that I really learned a lot in the last hour from all of you. So thank you for sharing the information.
Great. Thank you for your question, Dor. The rest of you now could speak, so we'd love to learn about who's here and what you're up to, and feel free to ask any other questions in the couple of minutes we have left. All right. Well, on behalf of the New York Chicago Booth Alumni Club, I want to thank everyone for attending today. I hope the session was meaningful. Certainly thank you to our speakers and panelists for taking time out of their busy schedules to share with us a little bit of insight as to what it means to do their job and allowing us to tap into their experience, which is certainly helpful. So we are grateful, and thank you for agreeing to participate today, and those of you in attendance, thank you again for joining us. So we hope to see you at future events and wish you all a good night.